In this topic, we will go through some normal growth strategies when trading in the stock market. This diagram shows you some capital growth strategies that include short, medium, and long-term strategies in trading and investing financial equities. Growth strategy number 1. Buying the general market include buying and selling exchange-traded fund is a strategy that being used by certain trader to gain money in the market consistently. An ETF is a pool investment vehicle similar to a mutual fund that offers investors a proportionate share in a pool of stocks, bonds, commodities, and other assets. The key distinguishing feature of an ETF is that it trades throughout the day on an exchange at a market-determined price, just like a stock. Many exchange-traded funds like Dow Jones or any main market in all around the world have registered phenomenal growth since the introduction. Because of this steady exponential growth, it always been an option for investor as well as trader all around the world to include ETF in their portfolio. Trading and investing in the general market is considered to be safe, less volatile, and give an expected steady return every year. From the past data, one can expect an average return of 10 to 12% steadily investing in the index every year. Next, we move on to a second strategy, which is value investing. Value investing is the strategy of selecting stocks that trade for less than their intrinsic values. Value investors actively seeking stocks of companies that they believe the market has undervalued. The investor looks for stocks with strong fundamentals, including earnings, dividends, book value, and cash flow that are selling at a bargain price given their quality. Value investing always emphasizes on a mentality that sees a stock as the vehicle by which the person becomes an owner of a company. To a value investor, profits are made by investing in quality companies, not by trading. This is a long-term growth strategy as the same as growth strategy number 1. They are seeking around 15 to 25% steady return. Linked to the price of something else. Specifically, options are contracts that grant the right, but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. Before stock investors might make 10% or 20% return on a stock, aggressive options investors could potentially make 100 or 1000 return in the same amount of time. Any investing carries a certain amount of risk. With more return potential, options investing assumes greater risk, so you should make sure you understand the pros and cons of any strategies you are considering before you start actively trading. Anyone who invests in options or any leverage vehicle are advised to realize the risk involved. It is usually not for beginners, as trading options is really risky if the price going against you. It is advisable that you gain your experience and getting expert at normal share price before going into further aggressive vehicle like options for leveraging. As you can see in the diagram, growth strategy number 1 requires less financial intelligence and perhaps a safer vehicle with lower return. As you go along each strategies to the bottom, the higher the financial intelligence needed in order for you truly success in the higher return financial vehicle. Thus, when you just started trading, it is advisable for you to go at least strategy number 3 in normal stocks and shares before you go further to growth strategy number 4.